Welcome back. Now, increased delistings from the JSE have raised concerns over SA Equities investment outlook. This is due to limited new listings, weak local share performance and low business confidence. The discourse shifts to the impact of market concentration on investment portfolios rather than just the number of delistings. And joining us now to offer more insights is Head of Investments at Morningstar South Africa, Sean Neethling. Thank you so much for your time, Sean. I actually just want to find out, is the delisting trend entirely troublesome, considering that a lot of the delistings that I've seen over the last while are based on increased international investor appetite into South African companies. So these companies investing in South Africa and swallowing up these JSE listed companies to the point of delisting.
Yeah, firstly, good evening, Zanati, to you and your listeners, and thank you for having me on the show. So I think, look, from our side, if you look at the market today versus, let's say, 20 years ago or 25 years ago, it's actually very different. In 2000, the index was dominated by mining companies. And today, the index is a lot more diversified, but still heavily concentrated. So you've got the top 40 stocks making up about 85% of the market cap. So it's a very concentrated market. And again, the way that we look at things largely is, because the market is this concentrated, for most, fund managers that are somewhat benchmark cognizant, they have been allocating capital in a way that suggests that the market is a lot narrower than what it is. So even before the delistings, because capital is largely flowed into those more concentrated holdings, you are seeing that because those listings, again, like you mentioned, smaller companies that sit largely outside those top 40 stocks. So we do think that the trend is somewhat concerning, but we think that market concentration has largely driven behavior for a long period of time. And that's already sort of reflected in the way that funds, particularly institutional and retail portfolios, are currently constructed.
Yeah, we're going to go back to that market concentration and obviously how investors can navigate that. And you are right, it seems like a lot of the market is, the mining companies, but also heavily skewed towards Chinese tech, as obviously we know the concentration that Naspers and Prosus have on the JSE. Now, in terms of new listings, from what I gathered, also the new listings that we've had are mostly companies that have been unbundled from companies that are already on the JSE. Is there just very little appetite for entirely new IPOs on the JSE at this point?
Yes, Nati, that's a really good question. Again, I think, delistings, again, in South Africa sort of been isolated. But if you look globally, it is a trend. So net, let's call it listings, downward trending in the US, let's call it IPOs down. The same sort of evidence from Europe and from the UK, where you've had this M&A or merger and acquisition activity, which has largely sort of taken, let's say, like smaller companies off the index and then sort of consolidated them into bigger companies. So I think the one that's probably the most prominent in South Africa, SAB Miller, a very big part of the index a few years ago, effectively swallowed up by A&B InBev. Again, so we're delisting, but at the same time, absorbed into a bigger company. And again, that's just leading into this market concentration that you're seeing. So again, I think in South Africa, largely just following the trend that we're seeing in global markets. But to your earlier point, again, you've got these secondary listings, I suppose, what you would call rand hedge stocks. A lot of the earnings actually come from offshore. So although we've got this very concentrated index, because we've got these secondary listings that are largely global companies that happen to be listed on the JSE, investors do get this diversified portfolio that is somewhat insulated from South Africa, even at the top 40 and let's say index level.
I hear you on the fact that this delisting trend is global, so the JSE is just following suit. But I'd just like to know, because also we do operate under a macro economy. Does the South African economic growth picture feed in somehow into appetite on the JSE, and maybe could appetite on the JSE, vice versa, feed into the SA economic growth picture?
Yes, I think so, Zanati. I think if you look at the South African economy, the JSE is not a really good proxy for what's happening in the underlying economy at the macroeconomy level. Most South Africans don't, unfortunately, have their savings sitting on the JSE. And I think, again, if you look at the way that the market is constructed, like I mentioned, a lot of those earnings are coming from offshore.
Yeah.
What it does mean, though, for example, again, if you just look at the construct of the industry over here, that you're finding that at this point in time, capital supply is largely restricted. And again, that's just investor sentiment, which at this point in time tends to be somewhat, more, let's call it, risk averse to emerging markets like South Africa. So there is a bit of a skew in terms of how these markets are hit, but very much an outcome of, at a point in the economic and in the capital cycle, you can expect that, let's call it, net listings are going to be lower.
How then do investors move to manage risk in a more concentrated market?
Yes, I think there's two parts to that, Sonati. I think the first part is, look, structurally the market is different, like I mentioned, if you compare it to 20 years ago. So while I think history is always going to be a good guide in terms of what you can expect from South African equities, I think it's important to be able to sort of disentangle those drivers of return. Again, if you take resources as an example, fairly cheap, and the whole South African market is cheap, but on a valuation basis, South African resource companies and miners are cheap. But the range of potential outcomes is potentially very wide in the short term on those. So although it's cheap, we do think that there's a lot of things that need to go right in order for that valuation to be unlocked in a very short period of time. And then I think the other change, which is a structural factor that it affects markets, that is very topical, is pretty much the change in Regulation 28 that allows managers to take more capital offshore. So I think going forward, what you're more likely to see is a portfolio that is a better mix of local assets and global assets. Investors can take up to 45% of that capital offshore. I think while that's also an opportunity, the other side of that coin is also that there's increased risk. So I think SA managers, we're certainly not of the belief, that global stock should be picked by global fund managers. We do think there's really good stock pickers in South Africa. But it's important to stay within that circle of competence. And I do think expressing yourself offshore needs to be tailored with, the demands of your clients on the local side as well.
Yeah, talk to me about a healthy mix here, because, obviously you talk about this Regulation 28 where investors can now take more of their money offshore. But at the same time, just looking at the JSE, we do have SA Inc. Stocks, but also those counters that do make up a significant size on the JSE, those offshore companies, your Richemonts, your companies that have that rand hedge benefit. Is it not safe to just invest on the JSE and split between SA Inc. and offshore, or do you need that diversification where you even just go outside of the JSE and use your Regulation 28 benefit?
So, Nadia, the work that we've done suggests that investment outcomes in portfolios do benefit from a healthy, let's call it, offshore allocation, north of 30%. So we do think that the regulation is net positive. But at the same time, moving from 30 to 45% is really a 50% increase from where it was before. And I do think, the ability to pick stocks offshore in this type of environment is particularly tough. And again, similar challenges that you have in a global market, where you have pretty much 7 or 8 companies accounting for the bulk of the return. So you have this concentration risk offshore as well. So I think a well-constructed portfolio, leans into the part of the SA mix that is, let's call it, safe and cheap. So if we look across that opportunity set, we think that banks are really well priced, paying good dividend yields. And we think, there's some caution warranted with resources, but again, on a forward-looking long-term basis, we think they're well priced. And on the global side, we do think it does provide that asymmetry in portfolios that, does provide a bit of robustness. So we think that it's a very good environment for stock pickers. And I suppose being less systematic at this point in time, again, where more things can go wrong than probably ultimately will go wrong.
All right. Well, thank you so much for your time, Sean, and really giving us insights into how to manage your portfolio. Really pertinent conversation as investors try to rebalance their portfolios for the year. That was Head of Investments at Morningstar South Africa, Sean Neethling.